The concept of efficient and inefficient price action is something that isn't discussed in great detail. When we're looking at efficient price action, what we would see is a series of 3 candles. You would see an up move that creates a high, another candle in the center, and a third candle. And essentially a basic explanation is the high of the first candle needs to meet the low of the third candle to be classified as efficient price action. What this means essentially is when price is moving up, both buyers and sellers had a fair chance at access to liquidity to continue the move. Because for every buy order, there needs to be a sell order on the other end, and for every sell order, there needs to be a buy on the other end. Now, if we're looking at inefficient price action, we can see that the high and the low of the third candle do not actually meet, which means this candle was pure buying power that ultimately created the move. And what that means is price is more than likely going to have to come back to this inefficient area of pricing to fill any liquidity that was skipped. If we're looking at a down move, it's the same concept. If we have a down move, we're looking at the low of candle 1 and the high of candle 3. These candles should meet in order to balance the pricing and make pricing efficient. Whereas in an inefficient price action, we'll see the low and the high of the third candle do not meet, which means price skip through any potential buying, and we're just offering sells from a volatility or liquidity standpoint. There was just too many buying positions here or selling positions here that made price move too rapidly to efficiently offer both buying and selling to occur. And again, price will more than likely gravitate back to these areas to balance pricing and liquidity. Now let's take a look at a few examples of inefficiency on a price chart. So here we are on the Japanese yen on the monthly chart. And if I just zoom in at the very beginning, what we can see on this chart, if we're just looking at the pure price action, we can see that price is broken structure quite impulsively. So we can note in an order block right here. And again, this candle was the bearish move before the up move that broke structure, but the next candle didn't engulf. It kind of just ranged within it. So we can actually refine to this candle here. So that's our order block, right? And what we can see is as price begins to rapidly move to the upside, we look at this top wick here and the wick of the candle after that, and we can see that there's this gap between the two candles. This is our inefficiency. What we can see is price, there were a lot of buy orders that were created here, placed here, and what we can see is price rapidly moved to the upside, which essentially and effectively skipped any possible selling that could be done here from a liquidity standpoint. And what we can see now, if I just change the color to, we'll go blue, you can see if we just look at this part, we have an inefficiency. And as price continues to move up, we can also see that we have inefficiency here and inefficiency here. Again, we can denote that from just looking at the gaps from this candle and then looking at the candle after that and seeing do these prices meet effectively filling the price action or the liquidity, the orders that were generated by this candle, were they offered again in an efficient manner? And in this case, no, this wick did not come to meet up with this, kind of effectively allowing buys and sells to be at efficient price action. Now what we can see is price then will rebalance. It'll seek back these inefficient areas in the market to then rebalance and continue. And what we can see here is overall pricing is efficient. The wicks are being met. We get to a top here. We start to push down. And what we can see is we've now created inefficiency here. We've gone down. We've tapped into this block of inefficiency, rebalanced, as well as this block of inefficient price action. We filled this bit of inefficient price action. Then we can see price is efficient, where the highs of these candles are being met with the lows of these candles, and price continues to move. Now, if we're looking at the order block in its own regard, we can see that price did not tap into the order block. It rallied up, and then it came down quite momentously to the downside. So a lot of bearish momentum in this move overall, especially looking at the monthly chart. We can see that price basically just blows through this order block. And the reason for that is because we had this inefficiency here, price tapped into it, and that's what funded this entire move here. So pairing that with the overall momentum to the downside, this just didn't have any more liquidity that was necessary to prop it back up. And we can use that as we're trading to basically vet out order blocks and use that as a gauge. If we see high momentum in the opposite way, returning back to an order block, and we've already effectively tapped into inefficiency and rebalanced those particular areas of price, then more likely than not, price will not respect that order block. So a key detail to keep in mind. But if we keep moving through the chart, what we can see now is we see price dropped fairly rapidly. It created inefficient pricing right here and inefficient pricing right here. And basically what you can see right off the bat is price moves down, creates a little bit of inefficiency here as well. If I just draw that in real quick here, but if we also look at this wick, this was actually efficient overall, the range of the candles, but we can see that price did still fill in the gap of the efficiency. And if you're looking at that on lower time frames, this would more than likely be a break and retest trade, which is basically the explanation as to why this happens, whether it be an order block or inefficiency. There is an actual reason for why this is occurring in the market. It's not just a technical phenomenon. It's actually order flow taking place in the markets. And what we can see now is we have inefficiency here. Price then blows to the upsides. We have inefficiency here. Price then rebalances the inefficiency. There is still some inefficiency remaining, but overall, the inefficient move has been filled and price continues to the upside. Now, we may note of this pricing inefficiency. So if we bought down here, this would be a great target to look at, and we can see price gravitates in it. And if I just take note of this inefficiency here, price comes down, closes it, and then fuels the move, and that's where we start to see more momentum. When you're looking at trading earlier on in your trading career, you would see this and not fully understand why price is doing this. We would say, oh, we're just in a consolidationary period. But essentially, this is the actual reason we can see we have created that actual inefficiency in price. Price needs to rebalance before it can continue. And we can see that price then continues to the upside. We don't quite make it to this target of inefficiency as of yet, but we can see that then price overall is very efficient in how it's moving. See, for every wick is being filled except for the spot, but then we can see price then just blasts through it as we look at the overall momentum is to the upside. And that's why we don't just simply trade inefficiencies for the sake of inefficiencies. Now, if we were looking on a lower time frame, had say an order block here, and we were looking at taking a buy and then navigating to a monthly chart and seeing this inefficiency, we would have a great target to look at. But we can see price then goes to the upsides, fills in this inefficiency completely. I'll just get rid of that to clean up the chart here, and we'll just kind of keep looking through price. We can see, again, we create inefficiency here as price moves to the upside. Price then spikes down, fills the inefficiency, and then continues back up. And we can see in this instance, we actually do have a order block. We can see price breaks structure here, taps in, one tap into the order block, two taps, and basically price fails to create an actual true higher high, and then continues to break to the downside. And then if we look, we have some inefficiency right in this area, and we also have inefficiency in this area, and then inefficiency in this area as well. And we can see if we just drag that to the upside, because initially as we were looking through the chart, we would have this overall area, which is a very large area, especially given that it's the monthly chart. This is 1,500 pips. As price continues to move up, we know that this is all inefficient price action and that price will likely come to these areas. And what we can see is price then does gravitate up to it. If we're just looking at a few more examples, we can see inefficient price action here. Price seeks the efficiency, fills it to the T, which is actually also a refined order block entry as well. The bridge structure down here. You can see that all these concepts do play hand in hand. We use order blocks as the main entry style, the actual point of interest that we're looking at, but we can use order blocks as overall points of interest for targets and such things, because what we can see here is we had the inefficiency that I called out that was here. We did fill it, but not quite. And what we can see is, although price moved and this returns back to it over, 3 almost 4,000 days later, you see that price does eventually come back to fill the inefficiency. And in this case, what we can actually see is this is also an order block entry. Price taps into it. So we've cleared out the liquidity that was sitting, or the imbalance that was sitting here. And then we actually tapped into the order block, and that's what has caused price to then move to the upside. If we were taking buys down in this area, we'd be looking at a few key areas of it targeting, and which would essentially be inefficiency here, and ultimately filling the inefficiency here. Now, we don't know if that's going to play out exactly, but if we were to take positions down here on, say, a 5-minute entry, looking at, targeting this inefficiency, that's over 4,600 pips, which could make you some hefty percentage. So you have an overall idea of what to target from a monthly standpoint, of course. And we can just see, again, price is efficient. We create an inefficiency. We break through it and continue being overly efficient in price. We create an inefficiency. We fill it, we carry on, we create an inefficiency, we fill it, and continue on to the upside. Price is efficient.
I just want you to know that I also share trading signals to community for free in the Telegram channel. For example, yesterday, I share the gold signals to community. You see all free TP getting profit yesterday, and the whole community getting profit by this trade. You can see every day I share trading signals to community, and most of them get profit. And especially, I do not only share the trading signals, but I also share the markup and the reason why I entered the trade. And by this one, everyone in the community can understand the reason, and by that, everybody can improve their trading skill. And to join community for free, you can click on the description of this video and click this link here, and you will be directed to the community and join for free.
And basically we get to current price, where overall pricing is relatively efficient at this current stage. It gives us a really great understanding of where price is likely to be gravitated to eventually. It's not saying that it's just going to start blasting to the upside to fill these particular areas right off the bat. We could still tap down, create some sort of point of interest and then go, or, as price we see, we could make a whole new bear trend and then eventually down the line fill these inefficiencies, because what we can see here again is we had small bits that eventually got filled, but this small little bit of inefficiency took well over 2,800 days to finally get there. So it does take a lot of time, especially looking at the higher time frame charts. But what we can see on, say, we'll go down to an hourly chart just for a few more examples. We can see that price just recently, we had a rapid move to the downside. We create inefficiency here and here. We can see price taps in, fills this area completely. The small bit of inefficiency gets initially tapped. There's some liquidity sitting here, which actually forms more sell orders and taps down. And then we can see price fills a little bit of inefficiency down in this particular area and continues up. Now, this isn't the main reason why price has reacted to these areas, but it's a good indication of where price is likely to start going. And as we can see, if I move just to the daily, for instance, and see price has been efficient. We had a little bit of inefficiency here, it blasted through it. If you were trading just simply the inefficiency, looking for a buy, that wouldn't make sense. These are more or less for market understanding, order flow understanding, and ultimately a great way to use for targets if we were looking for positions. A final example would be if you bought in and around here, you notice this inefficiency, you could target in and around that particular area. And what you'd also see is we also have a daily order block. It broke structure here. So a couple confluences if you were, taking that retracement buy in that case, because obviously you would not have known that price was going to break to the upside at that particular moment. But that is inefficiency in a nutshell. It's a great tool to understand what price action is doing, and truly it's a measure of volatility, but the volatility will eventually be matched with pricing that rebalances the orders that were skipped, essentially created the volatility in the first place.